Get ready to dive into the powerful forces propelling the Nikkei 225 back to record heights, with SoftBank Group at the forefront of this remarkable rally. As international investors return to Tokyo's vibrant growth sectors, the Nikkei 225 has reclaimed its historic peak. This momentum is fueled by stabilizing bond yields and a renewed interest in AI-related assets. SoftBank Group, 9984.T, has been a standout performer, with its share price skyrocketing by an impressive 75.62% over the last 3 months, jumping from 3,847.50 yen to a stunning 6,757.00 yen. The company is showing incredible strength, currently in a bandwalk phase after breaking through its upper Bollinger Band at 6,609.51. According to Nikkei CNBC, this record-setting rally is driven by SoftBank's AI narrative and a resurgence in semiconductor stocks. Shursen FX and Equity Forecast echoes this sentiment, noting that the strength of U.S. tech giants like Nvidia, which rose 15.4% to reach $215.33, has sparked a wave of foreign investment into Japanese tech. While traditional value stocks like Mitsubishi UFJ Financial Group, 8306.T, also saw gains, with a 30.01% rise to 3,091.00 yen, the focus has clearly shifted to high-beta growth. With SoftBank's volatility at 91.38%, the market is making a bold bet on the AI revolution. For global investors, the Nikkei has transformed from a defensive play into a dynamic hub for AI capital. What could Kevin Warsh's proposed 4 resets plan mean for the Federal Reserve and your investment portfolio? This could be the start of a radical transformation at the Federal. As a leading candidate for Fed chair, Warsh is advocating for a regime change agenda focused on 4 key resets. Financial analyst Graham Stephan, with his impressive following, highlights Warsh's intention to significantly reduce the Fed's staggering $6.7 trillion balance sheet, marking a fundamental shift in the central bank's influence. But that's just the beginning. Warsh also proposes to cut the frequency of Fed meetings from 8 to 4 a year, signaling a shift away from micromanaging every market movement. Additionally, he aims to replace the PCE inflation gauge with the trimmed mean inflation rate, which could provide clearer long-term signals. The Wall Street Journal indicates that Warsh's leadership could reshape Fed independence, suggesting an end to the Fed put, where the central bank intervenes to rescue markets. If Warsh takes charge, we might see increased market volatility as the Fed steps back, urging the markets to navigate on their own. This potential regime change is something every global market participant needs to consider now. Shifting our gaze to the Middle East, we're witnessing a pivotal moment in geopolitical risks that could reshape market volatility. The Financial Times reports substantial progress toward a 60-day ceasefire between the United States and Iran, a development that could have profound implications. This potential agreement includes a phased plan for reopening the Strait of Hormuz, a vital artery for global energy supplies. The immediate market response has seen crude oil prices cool down, alleviating some inflation concerns worldwide. Yenzo Market, a seasoned Japanese FX analyst, points out that this de-escalation has triggered a simultaneous drop in both crude prices and long-term U.S. Treasury yields. This dual decline could act as a powerful tailwind for global equity markets, especially for energy-importing nations like Japan. For investors, this shift is more than a mere blip. It signals a potential structural change in the risk premium embedded in the markets. If the 60-day window remains intact, we could see a broader return to growth sectors as the geopolitical tax on the global economy lessens. However, it's crucial to stay alert. Any breakdown in negotiations could quickly reverse these gains. Keeping a close watch on these talks is now essential for those tracking the next phase of market recovery. SoftBank Group has long been viewed through the lens of its vision fund's volatility, but a new narrative is fundamentally altering its valuation framework in the Tokyo market. The core of this shift is SoftBank's reported 13% stake in OpenAI. According to an expert panel discussion on Nikkei CNBC, this stake alone could be worth an astounding 20 trillion Japanese yen upon an initial public offering. To put this in perspective, this valuation would rival the market capitalization of some of Japan's largest corporations, suggesting that the market may still be significantly undervaluing SoftBank's total assets. The momentum toward an IPO is rapidly accelerating. CNBC, a leader in U.S. business news, reports that OpenAI is preparing for a confidential IPO filing, with global investment giants Goldman Sachs and Morgan Stanley providing advisory services. This move signifies that the transition from a private startup to a public giant is imminent. Masaki Kamioka, a Japanese strategist and author, provides a compelling structural view on why this matters. He suggests that the synergy between ARM's dominance in chip design and OpenAI's massive compute requirements positions SoftBank as the primary proxy for the global AI era. This is not just an investment, it is a strategic control point in the AI supply chain. Turning to the technical data for SoftBank Group, ticker 9984.T, the stock has shown explosive growth. Over the past 3 months, the price surged by 75.62%, climbing from 3,847 Japanese yen and 50 sen to a recent close of 6,757 Japanese yen. While the RSI stands at 66.4, indicating it is approaching the overbought threshold, the stock remains in a strong uptrend, trading above its major moving averages, with the SMA 5 at 5,757.8 and the SMA 25 at 5,504.64. The Bollinger Bands show the price currently breaking through the upper band, suggesting a powerful band walk momentum. For individual investors, this development transforms the tech and semiconductor sectors into high-conviction areas. The primary scenario to watch is the official announcement of the OpenAI IPO filing. Any concrete valuation figures will likely trigger a massive repricing of SoftBank's net asset value. However, investors must also monitor the MACD, which recently showed a dead cross on May 15, suggesting potential short-term volatility. The key question is whether SoftBank can maintain its premium as the gatekeeper to the AI revolution. If the 20 trillion Japanese yen valuation holds, the impact on the Nikkei 225 will be profound, potentially lifting the entire Japanese market to new heights. The Japanese bond market is reaching a crucial juncture. The 10-year Japanese government bond yield is on the rise, driven by speculation that the Bank of Japan may need to hike interest rates sooner than anticipated. Nobujuku, a technical analyst with extensive experience, identifies this yield surge as a response to the yen's ongoing weakness. He warns that the 160 yen line against the US dollar is a critical threshold for the Ministry of Finance. If the currency dips below 160, we could see immediate market intervention. Traders are testing the BOJ's resolve, daring them to act before the yen experiences further decline. Meanwhile, Yenzo Market suggests the market is probing the BOJ's patience. Despite rising domestic yields, the yen struggles to stabilize due to the wide interest rate gap with the US. This retreat from perceived intervention lines indicates that authorities are waiting for the right moment to act, yet the market's patience is running thin. For individual investors, this macro volatility is creating a stark divide in equity markets. The banking sector stands to benefit from this rising yield environment, with Mitsubishi UFJ Financial Group, 8306.T, showing a remarkable 30% increase over the past 3 months to 3,091 yen. Technical indicators for MUFG suggest relative strength, with prices holding above the 25-day moving average and a bullish MACD Golden Cross confirmed on May 12. Conversely, while SoftBank Group, 9984.T, has surged 75.6% to 6,757 yen on AI-related momentum, it remains sensitive to rising yields that could impact valuations. Currently, SoftBank is in a band walk near its upper Bollinger Band, indicating extreme momentum but also heightened volatility. Looking ahead, the coming weeks could be decisive. If the 10-year JGB yield continues its upward trend without stabilizing the yen, the BOJ may need to pivot as early as the June meeting. Investors should keep a close watch on the 160 yen mark and upcoming inflation data. A breach of 160 would not only move the currency but likely trigger a significant repricing across JGBs and the Nikkei 225. The era of ultra-low rates is ending, and the transition is proving to be anything but smooth. Nvidia is taking bold steps to tighten its control over the global AI supply chain. CEO Jensen Huang recently called on partners to implement stricter compliance measures to uphold supply chain integrity. This move comes in the wake of serious export control issues faced by key partners like Supermicro, also known as SMCI. As reported by Investing.com, Huang's push for transparency is a strategic maneuver aimed at shielding Nvidia from geopolitical risks and regulatory penalties that could disrupt its impressive growth. For global investors, this shift marks a transition from an era of unchecked AI expansion to one characterized by stricter oversight and potential regulatory challenges. This change comes at a critical time for the broader market. Breaking Points, an independent political and economic analysis program, has raised alarms about a possible AI bubble. They caution that the U.S. economy could face destabilization if massive investments in AI infrastructure fail to deliver returns quickly. The widening gap between hardware investments and actual software revenue makes the reliability and legality of the supply chain increasingly vital for sustaining market valuations. Technically, Nvidia's stock reflects this cautious optimism. Over the past 3 months, the stock has risen 15.4%. Climbing from $186.60 to $215.33. While the price remains robust, technical indicators suggest a consolidation phase ahead. The RSI currently rests at a neutral 53.7, and a MACD dead cross was noted on May 21, signaling a potential cooling of short-term momentum. Investors should keep a close eye on compliance updates from SMCI and Nvidia's navigation through export-restricted markets as key indicators for upcoming price movements. Next week marks a pivotal moment in the global macro landscape with the release of the U.S. Core PCE Price Index and crucial signals from BOJ Governor Kazuo Ueda. These two events are poised to shape the trajectory of the yen as we approach June. Zikkei Shimbun, a specialized Japanese market news outlet, indicates that these developments could trigger a definitive trend, potentially ending the recent spell of directionless volatility. The spotlight is on the divergence between U.S. and Japanese monetary policies. Yenzo Market, a respected Tokyo-based FX strategist, anticipates significant volatility around the 159.50 level. If the core PCE data comes in hotter than expected, it may accelerate the regime change narrative for the Federal Reserve, reinforcing the outlook for higher for longer interest rates, driving aggressive US dollar buying and putting intense pressure on the yen. Concurrently, Governor Ueda's speeches will be closely monitored for insights into the BOJ's balance sheet reduction and future rate hike timelines. For international investors, timing is everything. A hawkish shift from Ueda, coupled with easing U.S. inflation, could lead to a massive unwinding of yen carry trades. However, if U.S. data remains strong while the BOJ adopts a cautious stance, we could see the 160.00 psychological barrier tested once again. Investors must stay alert to these developments, as the interplay between these data points will define the next major shift in the FX markets.